In today's video, I want to show what happens when a trade goes against our analysis of the market. Instead of showing you just trades that develop perfectly, it's important to show the uglier side of trading so you can learn how to manage yourself in these difficult situations when they appear. Let's first understand what led to the opening of the sell position you see on the chart. In number 1, we have a horizontal support line that is later zoomed by candle marked in number 2, which turns this line into a resistance. Notice how candle 2 zooms the line with a considerable amount of power. This is not just a simple line shifting from support to resistance. Due to the way candle 2 zoomed the line, we can consider this as a point of ignition or a level where sellers are ready to show up again, as it happened a few moments before this sell position was opened. In candle number 3, we can see a very clear support level being formed, which can be used later as the center line of an equidistant horizontal channel to pinpoint possible target points. In number 4, we draw the outer line of the equidistant horizontal channel to pinpoint a target that will give us at least a 1-to-3 risk-reward ratio on this trade. Number 5 shows a possible market manipulation of the support line marked in number 3. Notice how price breaks down the line and then immediately goes back up in an organized manner. This leads many retail traders to believe that the market was going down. Once again, if this is indeed a market manipulation, market makers want everybody to think that the market is going down, so they can take the opposite position and go long. In number 6, price goes back to the ignition point that we identified in number 1 and 2. Beyond that, we have a simple momentum divergence inside the orange rectangle plus a fractal bar in candle number 6. A fractal bar or fractal candle is a way of layering the concept of reversal divergence with the fractal analysis of the market, which is a way of pinpointing momentum asymmetries in price in a much more accurate and subtle way. Notice also that in candle number 7, the market opens with a slight gap down, showing the strength of the sellers at this moment, which is the deal breaker to open the sell position in candle number 8. The stop loss was placed a few pips above the fractal bar and the ignition point of sellers, and the take profit was placed at the outer line of the equidistant horizontal channel marked in number 4. Our target has to be placed there to give us at least the possibility of obtaining a 1-to-3 risk-reward ratio. Remember that there are a few different reasons for us to shoot for at least a 1-to-3 ratio. These reasons are mathematical, statistical, and psychological. We want to have an expectancy higher than 1, a realistic statistical edge, and we obviously want to avoid the psychological traps of hyperbolic discounting. If you want to understand a little bit more about that, check out the video called The Dark Side of Scalping. Back to our analysis, our stop is about 8 pips and our target is about 24 pips, which gives us a 1-to-3 ratio. However, before price can get to our target, there is a major barrier encountered in the zone between number 3 and number 5, because that's where the manipulation might have occurred. It's important to stress out that even though this has all the elements of a manipulation, we have a perfectly reasonable context for our sell trade idea. Let's see how the market plays out. At this moment, price is exactly inside the zone where the manipulation might have occurred. If you notice carefully, I have moved the stop-loss order a few pips below break-even level to protect our sell position. This is a technique called risk collapse, where you protect the position once it is already in profitable territory if you have a situation like this one where we cannot know if sellers or buyers will win. This means that we will either be stopped out with a small profit or price will meet our target with a 1-to-3 risk-reward ratio. This can be viewed as an emergency procedure if you entered a trade that is good enough to generate enough profitable territory, but you're not sure if it is strong enough to hit its original target. Let's see who wins the flow of the market. Here we can see that the market comes back and hits our stop-loss order. That means that we indeed recognized a manipulation in the zone between 3 and 5, and we could have built a context for a buy trade in this area. However, we were distracted by the minor flow going down the market, and it was difficult to tell which flow had the largest amount of power. Either way, we employed emergency procedures to make sure our equity suffered the minimal amount of damage. Even if we didn't collapse the risk, the worst thing that could happen was price hitting our original stop-loss level. Since we always trade with good risk-reward ratios, that's not a problem at all and it will happen. The important thing is to maintain an expectancy level higher than 1 with good risk-reward ratios. By doing that, we can easily support losses like this because one winning trade is capable of giving us enough to give us peace of mind to lose 3 or 4 trades without losing capital. I want to stress out that the risk collapsing technique can only be employed if our position has enough profit. If you try to collapse risk as soon as your position enters profitable territory, you will get burned repeatedly. In this video, you saw a real-life example of how to manage risk like a professional trader. Hopefully you enjoyed it and learned something useful for your own trading. Don't forget to subscribe to our channel and leave your feedback below to support us. Don't forget to check out our other videos as well. We have a lot of free high-quality information available on the channel. Thank you for watching.